Hello, today we're going over a quick video for Coca-Cola, ticker symbol KO. Right now we're currently looking at their free cash flows since 2009. As you can see here, they've been pretty steady. They're a pretty steady company regarding their free cash flow. Um, so we're not really too concerned about them declining year over year when 2020 was a really big jump from their normal numbers. Um, they're always paying their dividends, so that's not something that we want to worry about right now. If you look at their quick ratio over the last 10 years, um, you know, these are their numbers, not that bad, 0.95. Current liabilities, current assets, and inventory, but they have more assets than that. So if you're going to go over here, you can look at assets and liabilities. Total assets, 98.456 billion. So you want to come over here, we can put this into their total assets, their total liabilities, and those just give you kind of like book value. So let's go ahead and put in 98.456, and then liabilities 70904. So 09. Total shares. You go to revenue and profit. You can see here. Let's look at their revenue. I'm sorry, I'm recovering from being sick, but I'm a lot better now. But as you can see here, they're pretty steady with their revenue. They had some declines, but look, it's picking up year over year, and we're getting back to normalcy for their revenue. Currently, even over the last 12 months, we're at 44 billion, which is a 6.82% increase. The quarter ending June 2023 was a 5.71% increase, which is why we're going to continue to use a 5% growth rate for Coca-Cola to try to determine a fair value. Their net income, as you can see, it's increasing again, 9.8% increase. So the quarter ending though was a 33% increase for net income. Shares outstanding, they did continue to decline. You can see here most recent years they're declining, which is good. They're generally declining. So for their outstanding shares, 4341. Go ahead and put this into the thing. 4341. A NAV value $6.34. That's about book value. EPS continued to increase, 10% increase year over year. They're currently at 2.42, which is why we can come over here to the Benjamin Grant. 2.42, 5% growth rate. Bond rate currently around 4%. For PE of no growth, usually this number is way lower, but we're going to use 20 for a company like Coca-Cola, which is going to bring us around to an intrinsic value of $53.37. Their current price, that is not accurate. So if we come over here to the current price, we want to erase that because that's not accurate. So if we come over here to prices, we can see the latest closing price for Coca-Cola is $58.33. So $58.33, according to this calculation, we would be very close to getting to intrinsic value for Coca-Cola, which is a company you'd want to pay premium for. If you want to go to a 25% PE no growth, look, we're already at a good trading value, but that doesn't give yourself any safety for a company like Coca-Cola. So we're going to go with 20 PE ratio. As you come over here, you can look at their price ratios. So PE ratio currently at 22.43. And you can just see where they trade their PE ratios over the years and quarters. So yeah, you can always look at price to book ratio is 9.5. They have these net ratios here. This is all on Macro Trends. It's a website that's free for people. That's why I like to use it. Because there's a lot of good information out there. If you come to their financials, you can get their income statement, their balance sheet, cash flow statement, key financial ratios. So this website has all kinds of things that you can use for free and help you make your decisions. Here's their long-term debt. It's decreasing 3% year over year. So we're going to come over here to our discounted cash flow calculator. We're just going to use the last 4 years for Coca-Cola because these are around normalcy numbers. Growth rate we have inserted is 6%. We were going to use 5%, but I guess I got 6% in there right now, which is fine. 8% discount rate. 4341, discounted cash flow price $52.27. Then we have our 10%, 20%, 30%, and 40% margins of safety. If we do move this down to 5%, as you can see, $48.39. It's going to change it a little bit. And 5% growth rate is something I'd like to see. We can always check out Seeking Alpha to see what potentially their forwards guidance is and what it's projected to grow by analyst. Discounted cash flow, we can come over here, and this one we can use, which is a more aggressive one. Gives ourselves less margin of safety. All we got to do is take the average cash flow to start from, which should be 9807. We're going to go with that 5% growth rate and 2% perpetuity, and then we're going to go ahead and 4341. Get rid of this 10% growth rate, 8% for a company like Coca-Cola. It's going to bring us to a discounted cash flow price of $60.34. And then you can see our 10% discount rate is going to be very similar to this price when it was at a 6% growth rate. But it's it's still going to be more than that. That's why we call it aggressive. And then a 20% discount rate, as you can see, is almost nearly identical to the regular discounted cash flow. So it all depends on your margin of safeties when you're valuing businesses like this. And for me, I like to use my conservative discounted cash flow. But for people that are more aggressive and don't mind not making as high as a return and just want to invest in a company that's safe and going to continue to grow dividends, this isn't a bad model. As you can see here, this one takes account other metrics. But we're going to go to the dividend discount model. We're going to use a 4% growth rate. The current dividends is 1.91, 8% discount rate. Current price is not $127. So we're going to put in the correct excuse me, the correct one, and we're going to KO. Current price $58.33. Dividend discount model per share with the 4% growth rate would be $49.66 with the 8% growth rate. So as you can see, a little bit overvalued even when doing that. Now, if we were to project this out already, which is already right here, 1.84 times 4, 1.91. So it is projected out. Okay. So actually, this is I already have it on there. So it's $1.84 per year, and I already added the 7 cents here, which is 1.91. I'm projecting their most likely dividend increase is going to be happening very soon for Coca-Cola because they've already paid out 3 dividends this year. So 1.91, 4% growth rate, 8% discount rate. Then we do come to this $49.66 dividend discount model. So if we go ahead and enter in our metrics here, 49.66. Benjamin Graham, we have a 53.37. 53.37. If you like to do it this way. And then we have our $48.39. So you can always go ahead and get the average. So how you do that here in Google Sheets is you click average, and then you click this year, and this year. And then you're going to get an average price of $50.47. So if you don't want to give yourself a margin of safety, this is obviously going to change the numbers a lot. Like there's a lot of people that don't want to worry about additional margin of safety, so their calculations aren't as aggressive, which is why we have models like this where it will come to the $60.30 for the discounted cash flow. Coca-Cola is a great company, and I would not be opposed to buying at $58.37. Majority of my Coca-Cola I bought in 2020 when I was first even learning how to invest, so I got lucky. I didn't really know how to value businesses that well. So, I did end up selling them around $58 in 2021, but I kept, half of my portfolio in it when I learned that they were overvalued when I was learning about investing. And now I just leave it to ride. I would like to see it hit $50. If it hit $50, I would add a small position. But if I was going to add more Coca-Cola, I would be looking at $45. $45 I think is a great price and gives me a margin of safety. And if we go to our discounted cash flow model, it's a little bit above the 10% margin of safety. So, it's a good middle margin to give me some safety. So yeah, that's my valuation method for Coca-Cola, and let me know how you value them as a company. I'd be really interested to see if you guys think I'm undervaluing them or overvaluing them. Thank you.